If you're an investor, a trader, or someone just trying to make sense of the markets, the news that Trump's tariffs are back is not just a headline. It's a signal that the landscape of investing might be shifting again. Tariffs, for better or worse, act like an economic earthquake. When they hit, they don't just affect the companies directly involved in imports or exports. They ripple through entire industries, investor sentiment, investment, and even the way international markets interact. For someone trying to build wealth, understand risk, and make strategic decisions, knowing what this means is critical. The first thing to understand is that tariffs introduce uncertainty. Markets hate uncertainty. When a company knows it will face higher import costs, or when traders anticipate disruptions in supply chains, stocks can swing dramatically. This isn't just theoretical. And history shows us that whenever trade tensions rise, even rumors of tariffs can trigger rapid sell-offs or sector rotations. Investors who aren't paying attention risk being caught on the wrong side of these shifts. At the same time, volatility can create opportunities for those willing to act strategically. Knowing how to read these signals, how to predict potential outcomes, and how to position yourself accordingly is where disciplined investing meets opportunity. Next, investment. Consider which sectors are most affected. Industries like technology, manufacturing, and consumer goods often feel the direct impact of tariffs. Companies relying on imported components suddenly face higher costs and squeezing margins and sometimes forcing price increases for consumers. On the flip side, certain domestic producers might benefit from protectionist policies as imported competition becomes more expensive and local alternatives gain traction. Understanding these nuances, knowing not just which sectors are affected but why, can give an investor a decisive edge. For instance, a company with diversified supply chains may weather tariffs better than one heavily reliant on a single foreign market. Recognizing this difference can be the line between profit and loss. Beyond the US borders, the global trade landscape is equally crucial. Tariffs are not just a domestic issue. They affect relationships with major trading partners like China, the EU, and Mexico. Retaliatory measures, slowed negotiations, and shifts in global supply chains can have a domino effect across multiple industries. Investors with exposure to multinational corporations or emerging markets need to understand these ripple effects because what happens abroad often comes back to impact domestic portfolios. This makes staying informed about policy updates, international news, and trade negotiations a core part of modern investing. Finally, the question for any serious investor is, what should I do about it? Strategies vary depending on risk tolerance and investment horizon. But there are practical steps that can help mitigate risk. Diversification across sectors, hedging strategies, and identifying companies with strong pricing power or resilient supply chains are all ways to prepare. At the same time, keeping an eye on opportunities, stocks that could benefit from tariff protections, commodities affected by international trade, or companies innovating around supply chain challenges can position an investor to profit even in turbulent times. In short, Trump's tariffs coming back isn't just a news story. It's a market event that demands attention, strategy, and informed decision-making. Understanding the volatility, the sectors, the global impact, and how to adjust your investments accordingly isn't optional for someone looking to grow wealth intelligently. It's essential. Staying proactive, not reactive, is the key. When it comes to investing, one of the first things you learn is that markets react not just to facts, but to fear, anticipation, and perception. The reintroduction of tariffs creates exactly that, a wave of uncertainty that ripples through stock prices, investor sentiment, and market behavior. At the core, tariffs are essentially taxes on imports, but their real impact is far more complex. For companies, tariffs increase the cost of goods, raw materials, or components imported from other countries. For investors, this translates into higher uncertainty about earnings, potential profit margins, and overall stability. The very idea of an additional cost or barrier can spark immediate reactions in the stock market. Even before companies report earnings impacted by tariffs, markets often adjust based on expectations. Prices can swing in anticipation, sometimes creating sharp sell-offs or sudden rallies depending on the perceived winners and losers. Historically, when trade tensions rise, markets become more volatile. Look at past instances where trade policies shifted suddenly. Indices fluctuate more than normal, sometimes within a single trading session. Investors who are sensitive to these swings may panic, leading to irrational selling or buying. The volatility is not limited to stocks directly affected by tariffs. For instance, a manufacturing company may face higher costs due to imported components, but suppliers, distributors, and even competitors can feel indirect effects. Traders start to price in these potential disruptions, and the ripple spreads across sectors. For someone with a diversified portfolio, this volatility can feel like a double-edged sword. On one hand, it increases risk, but on the other, it creates opportunities for those who understand market psychology and can anticipate reactions. Investor sentiment, the collective mood or perception of market participants, plays a huge role in how tariffs impact the market. When tariffs are announced or rumored, sentiment can shift quickly from optimism to caution. Even if the long-term fundamentals of a company are solid, short-term sentiment can drive stock prices down because investors react emotionally to uncertainty. Fear of profit erosion, concerns over trade wars, or speculation about retaliatory measures can push people to sell prematurely. Conversely, optimistic sentiment about domestic industries that benefit from protectionist policies can trigger rapid buying, even if the gains are temporary. Of understanding that markets are as much about psychology as they are about numbers is critical. Smart investors watch not only the data, but also how the broader market is feeling, because sentiment often drives short-term pricing. Another important aspect is that volatility caused by tariffs is not uniform. It fluctuates depending on the type of industry, the company's global exposure, and its supply chain resilience. For example, tech companies relying heavily on international components may experience sharper swings than domestic service-based businesses. Even within sectors, some stocks are more sensitive to tariff-related news than others, based on investor perception, historical performance, and liquidity. This is where being strategic becomes key. Investors can use volatility to their advantage through careful timing, hedging, or repositioning within their portfolio. Those who panic during these fluctuations often miss the chance to buy quality assets at discounted prices, while those who stay informed and disciplined can exploit short-term swings to their benefit. Finally, it's essential to remember that market volatility induced by tariffs is often temporary but intense. While headlines may make it feel like a permanent shift, careful analysis reveals that markets tend to adjust once actual impacts become clear. Companies may pass costs to consumers, adjust supply chains, or find efficiencies that mitigate the tariff impact. Investors who react impulsively may lose out, but those who stay patient analyze the implications carefully and position themselves based on risk tolerance and opportunity can turn volatility into a strategic advantage. Understanding how tariffs affect both investor sentiment and market behavior is not just an academic exercise. It's a practical tool for navigating uncertain times with confidence, clarity, and foresight. When tariffs are reintroduced, the effects are rarely uniform across the stock market. Certain sectors feel the brunt immediately, while others may actually benefit from the change in trade policy. For investors, understanding which industries are most affected is crucial for making informed decisions. Take the technology sector, for example. Many tech companies rely on complex global supply chains, sourcing components from multiple countries. When tariffs are imposed on imported components, production costs can rise significantly. This often squeezes profit margins and forces companies to either absorb the cost or pass it along to consumers. Investors watching tech stocks closely may see increased volatility, and companies with less diversified supply chains are particularly vulnerable. On the flip side, investment. Companies that have strategically diversified or secured domestic alternatives can weather the impact more effectively, sometimes even gaining a competitive edge over less prepared peers. Manufacturing is another sector that usually feels immediate effects. Industries that rely heavily on imported raw materials or machinery suddenly face higher expenses, and that can lead to reduced output or increased prices for end consumers. Automakers, for instance, often rely on a network of international suppliers, and even small tariff increases can significantly affect production costs. Investors need to pay attention to how manufacturers respond, whether they adjust pricing, negotiate with suppliers, or redesign production strategies. Some companies might pass costs to consumers without losing sales, while others may see declining demand due to higher prices. Now, understanding these dynamics can help investors anticipate stock performance in the short and medium term. Consumer goods and retail sectors are also directly impacted by tariffs. Imported goods, from clothing to electronics, become more expensive. Investment, which can reduce demand if consumers are price sensitive. Companies that rely heavily on imports to meet consumer demand may see declining sales and pressure on their margins. However, investment. Domestic brands could benefit as consumers shift their purchases to locally produced alternatives. Investors who spot this shift early can position themselves advantageously by investing in companies that are likely to gain market share. In some cases, retailers with strong supply chain management may even turn tariff challenges into opportunities by renegotiating deals or sourcing locally to maintain profitability. It's also important to note that certain sectors can indirectly benefit from tariffs. Domestic manufacturing, agriculture, and energy sectors may experience protective advantages as imported competition becomes more expensive. For example, investment-based manufacturers may see increased demand if foreign competitors face higher costs, and this can lead to stronger revenue growth and stock performance. Similarly, domestic suppliers of raw materials used by multiple industries might see higher orders as companies seek to avoid costly imports. Investors who understand these subtleties can make tactical moves by identifying sectors that are likely to outperform amid tariff changes rather than assuming that tariffs are universally negative. Finally, timing and strategic positioning are key. Tariffs introduce short-term shocks, but the long-term effects often depend on how companies adapt. Investors who focus solely on initial reactions may miss opportunities that emerge as businesses adjust. Investment. Companies that innovate in response to tariffs, whether through supply chain optimization, alternative sourcing, or strategic pricing, can outperform expectations, and these adjustments often create investment opportunities. Observing which companies are proactive, resilient, and well-positioned within their sectors provides a roadmap for navigating these market shifts effectively. In conclusion, the sector-specific impact of tariffs is complex and multifaceted. While some industries face higher costs and increased risk, others may benefit from protectionist measures or the ability to adapt quickly. For investors, the challenge and opportunity lies in identifying which sectors are vulnerable, investment, which are resilient, and which are poised to capitalize on these changes. By carefully analyzing sector dynamics, supply chain strategies, and market positioning, investors can make informed decisions that transform uncertainty into strategic advantage. Understanding these nuances isn't just useful, it's essential for anyone looking to succeed in a market influenced by tariffs and trade policy shifts. When tariffs are reintroduced, the impact goes far beyond domestic markets. Trade is inherently global, and any disruption in one country can send ripples across the entire economy. Investors need to understand that tariffs don't operate in isolation. They affect international trade relationships, supply chains, and even currency markets. For example, when the US imposes tariffs on imports from major trading partners like China or the European Union, it isn't just the companies directly involved that feel the effects. Countries may retaliate with their own tariffs, increasing costs for US exporters. This can reduce demand for American goods abroad, hurting revenue for multinational corporations and potentially impacting stock prices across sectors. Investors who ignore these global dynamics risk underestimating the full effect of tariff policies on their portfolios. One of the most immediate consequences of tariffs on a global scale is the adjustment of supply chains. Companies that rely on international suppliers may scramble to find alternative sources to minimize costs. This can create short-term inefficiencies and additional expenses, but it can also drive long-term strategic shifts. For instance, firms may diversify their supplier base across multiple countries or invest in domestic production to reduce exposure to international trade disputes. From an investor's perspective, understanding how companies navigate these changes is critical. Stocks of companies with flexible, resilient supply chains are likely to be more stable, while those that remain heavily reliant on a single foreign market may face increased risk. Currency fluctuations are another ripple effect that investors need to consider. Trade tensions often influence currency markets as countries respond to tariffs and trade imbalances. A stronger or weaker dollar can have a profound effect on multinational corporations, especially those with significant international revenue. For example, if the dollar strengthens against foreign currencies, U.S. exports become more expensive abroad, potentially reducing sales. Conversely, a weaker dollar may make imports more expensive, compounding the impact of tariffs. Investors who understand these currency dynamics can anticipate potential profit squeezes or gains in companies that have international exposure, positioning their portfolios accordingly. Tariffs also influence global economic growth. By raising the cost of imports and exports, tariffs can slow trade activity and reduce overall economic efficiency. For companies that rely on international customers or suppliers, this can translate into lower demand, higher costs, and constrained growth. Investors should recognize that these macroeconomic effects can be gradual but significant, shaping stock performance over months or even years. Conversely, countries or industries less exposed to global trade may benefit indirectly as investment shifts toward more stable domestic markets. Understanding these shifts allows investors to identify safe havens or emerging opportunities in times of global trade tension. Finally, geopolitical considerations cannot be ignored. Tariffs often strain diplomatic relations and can create uncertainty about future policy changes. Investors who monitor political developments, trade negotiations, and international responses are better positioned to anticipate market reactions. For example, a country threatening retaliatory tariffs or negotiating new trade deals can dramatically influence sector performance. Companies that actively manage international relationships or have diversified global operations may outperform those that are rigid and exposed. Strategic investors watch these geopolitical signals closely, using them to adjust portfolios, investment, hedge risks, or capitalize on opportunities created by shifting trade policies. In short, the ripple effects of tariffs extend well beyond domestic markets. They influence supply chains, currency values, global economic growth, and international relations. Investors who understand the interconnectedness of global trade can navigate these changes more effectively, identifying both risks and opportunities. Recognizing that tariffs are not just a local issue, but a global economic force allows investors to position their portfolio strategically, turning uncertainty into insight and potential profit. In today's interconnected world, a tariff in one country can affect markets everywhere, making informed global awareness essential for any serious investor. When tariffs are reintroduced, investors are faced with a question that goes beyond analyzing numbers. How do I adapt my strategy to protect my portfolio and even take advantage of the changes? The truth is, tariffs create both challenges and opportunities, and the key to navigating them lies in strategic thinking, discipline, and an understanding of risk versus reward. For investors who react impulsively, tariffs can feel like an obstacle. For those who plan and position themselves carefully, they can present avenues for growth and profit. The first step is to assess your portfolio and understand which assets are most vulnerable. Companies that rely heavily on imported materials or have significant international exposure are often the first to feel the impact. By identifying these positions early, investors can decide whether to reduce exposure, hedge against potential losses, or even temporarily exit certain positions until the environment stabilizes. Diversification becomes especially critical when tariffs are introduced. The more spread out your investments across different sectors, industries, and geographies, the more insulated your portfolio is against localized shocks. For example, while tech and manufacturing may be sensitive to tariffs, domestic-focused service industries or consumer staples may be far less affected. Diversification also allows investors to balance risk with opportunity. Some sectors may benefit from protective tariffs, such as domestic manufacturing or energy, as imported competition becomes more expensive. Shifting allocation toward these areas, or increasing exposure to companies with resilient supply chains, can help investors not only mitigate risk but potentially profit from the new environment. The goal is not to eliminate risk entirely. That's impossible, but to manage it intelligently while positioning for upside potential. Hedging strategies are another critical tool. Options, futures, investment, or other derivative instruments can provide a way to protect your portfolio from sudden swings caused by tariff announcements or retaliation measures. Even simple approaches, like investing in ETFs that track broader sectors less sensitive to trade disruptions, can serve as a buffer. The idea is to create a defensive layer that allows investors to stay in the market, maintain long-term positions, and capitalize on opportunities without being overly exposed to short-term shocks. Hedging isn't about predicting the future perfectly. It's about preparing for multiple scenarios and ensuring that one unexpected tariff announcement doesn't derail your overall investment strategy. Timing also matters. Markets tend to react quickly to tariff news, often overshooting in either direction. Stocks may drop on initial announcements only to rebound once companies adjust to the new environment or analysts reassess their earnings projections. But investors who remain calm and patient can take advantage of these fluctuations by strategically buying quality companies at discounted prices. On the flip side, jumping into investments solely based on headlines without evaluating fundamentals can be dangerous. Understanding the difference between temporary market reactions and long-term structural changes is crucial. Investors who can separate noise from signal will have a decisive advantage, as they can exploit volatility rather than fall victim to it. Finally, it's important to consider the long-term implications of tariffs and adjust your portfolio with foresight. Companies that innovate, diversify their supply chains, or capitalize on changing competitive dynamics are likely to outperform over time. Investors who focus on resilient businesses, monitor geopolitical developments, and remain agile in response to policy changes are in the best position to thrive. This may involve relocating capital gradually, increasing exposure to sectors that benefit from tariffs, or holding cash to take advantage of market dips. Strategy isn't about reacting emotionally, it's about analyzing data, assessing risk, and positioning for both short-term resilience and long-term growth. In summary, reintroduced tariffs demand a proactive, disciplined approach to investing. By evaluating vulnerability, diversifying strategically using hedging tools, timing moves carefully, and focusing on resilient long-term opportunities, investors can navigate market uncertainty with confidence. Tariffs create risk, yes, but they also create opportunities for those who plan ahead, stay informed, and act strategically in an environment where uncertainty is inevitable. The smartest investors are the ones who transform challenges into advantage, using insight and preparation to protect and grow their portfolios.